Hi guys, thanks for tuning in to another episode of Nuggets News. Today we've got a special guest, and that is Sam, one of the founders of the FTX Exchange, an exchange I've recently moved over to do all my trading, and we do have a link below for you guys to get a discount on fees. But thanks so much for joining us today, Sam.
Thanks for having me.
You've got a fascinating background in investing and trading, so why don't we start off with that and what led you to build your own exchange?
Yeah, I graduated from MIT 2014, and after that went to work for Jane Street, which is a Wall Street quant trading firm. I started trading international ETFs for about 3 years, and then left in 2017 to start up Alameda Research, which is a crypto quantitative trading firm. Alameda trades something like $1 billion a day globally, depending on market environments, across a bunch of different platforms. So I was running that for a few years, and then, somewhat recently, started up FTX, which is a crypto derivatives exchange.
So, to talk more about your approach to investing, a lot of people just want to, jump on and go 100x and hope it goes up. But
Yep.
you were taking that analytical approach and, trying to use arbitrage and a few different techniques, weren't you?
Yeah. So, I think sort of when we started out, really, we were just doing arbitrage. And, this is sort of late 2017. There's gigantic arbitrages everywhere. You just saw like Coinbase and Bitstamp Bitcoins trading 5% apart sometimes. It's a whole week where Coinbase Litecoins were trading $1 billion a day, like 20% above the rest of the world. And those are sort of the easiest things to do. And send Litecoin to Coinbase, you sell it for something, send that out, buy some Litecoin, send them back, and you just keep cycling that. And sort of over time, it's become a lot more sort of complicated and nuanced. And the reason is that markets have basically gotten more efficient over time. So now sort of how I think about trading is, the backbone of a lot of it is still arbitrage. It's still looking for cases where, I can buy at one price and sell at another price. But often it's not just a pure, ETH to Bitcoin arbitrage across two exchanges. Often, we're thinking about, well, what's a tether worth right now? If you can buy a Bitcoin for $10,600 and sell it for 10,620 tether, did you just do a good trade? I don't know. I mean, it depends on whether a tether is actually worth $1, and maybe you do an arbitrage, but you can only withdraw $100,000 a day from some exchange, and you've hit that limit. And in fact, you've got a giant backlog. And so now you're like, all right, well, I could do this, but this capital is just going to be sitting there for the next week while I sort of, wait my time in the queue. And a bunch of other things where, again, there is some sort of arbitrage principle underlying it, but there's some complicating factors. And, one of those that we, have done a lot of is derivatives trading. Is, if you have a futures contract and you have some spot market and they're not trading at the same price, is that an arbitrage? And the answer is sort of, if you're willing to hold it for a day or a week or a month or however long it takes to expire. But if not, then it's sort of more complicated.
Yeah, I guess that was the next question that I wanted to get into, because there was huge opportunities back in arbitrage in Australia a few years ago, but the limitations were always with the banking system and how do you get a bank in
Yeah.
Hong Kong or China. And I know you're pretty passionate, or you definitely use Tether a lot, because a lot of the retail have this image that it's backed by nothing and they print it out of thin air, and I
Right.
just don't agree with that at all. But the
Yeah.
tether is a more effective way to move dollars around to take advantage of these arbitrage opportunities, because a lot of the time you're waiting for Bitcoin to get 6 confirmations and that takes an hour. So do you want to talk about all that and how it's changed?
Yeah, absolutely. And as you said, like often you see a giant arbitrage and that's the easy part. And the hard part is doing it. And banking is a big part of it. I mean, the most famous cryptocurrency arbitrage of all time is the kimchi premium. In late 2017, early 2018, you saw as high as like a 50% premium for Bitcoins in Korea. The problem was that if you sell the Bitcoins there, you don't get like, Ether or Tether or a token, you get Korean won. And the Korean won's a restricted currency. This is not even specific to crypto. This is just true in general, that, you're restricted in your ability to get Korean won out of Korea. So you turn all your money into 50% more Korean won, but then just stuck there.
Mm.
And, what do you do with it? Well, there are a lot of different approaches, but all of them suck for one reason or another. And then you move on to, more tractable cases, but they're still a little bit tough. You want to do a big wire transfer across the world, you got to convince two different banks that they should be okay with a giant cryptocurrency originating wire transfer. And most banks in the world don't like crypto, and they'll just shut your account down if you try and do that. And so, anyone who sort of really tried to do banking in crypto quickly realizes it's not easy, and that lots and lots of banks are just not going to be okay with it. And sort of thus stablecoins were born. If I want to send $1 between Huobi and OKX, I don't have to do a wire transfer. I just send a tether over. You can send it now on the Ether or Bitcoin blockchains, and it takes 15 minutes and it's there, and no banking required. And that's sort of the miracle of stablecoins, is that they allow you to move dollars around the blockchain rather than having to use a bank account. Of course, in order for this to work, you can't just create the token. It has to be $1. Like something has to tie this to $1. And a lot of people have come up with a lot of metrics, and basically only one of them works. And the only way you really know it's $1 is if there's a bank account with $1 in it.
Yeah.
And you can send this to the bank account, and they'll wire you $1. And somewhere, somehow, someone in the world has to be able to do this.
Do you think that this is definitely why we're seeing JP Morgan and all these other banks launch their own coin, because it is so efficient and better than what they're doing? But it comes back to liquidity. And again, at the moment, Tether, if you need to move $1 billion, you can't really do that with a lot of these other coins, can you?
That's right. And you can look at on exchange volumes where Tether is, I think, more than half of all stablecoin volume. You can look at order books where that Bitcoin Tether order books are the most liquid spot order books in the world. And all the other stablecoins are still playing catch up. You can look at whichever metric you want, and they'll all say the same thing, which is that if you want to get in and out of 50 million Tether, you can do it with without having that large of impact. And other coins, it's interesting. Tether, your on exchange impact is tiny compared to the other stable coins, but your sort of creation redemption impact is actually quite a bit larger. And so the flip side of this is you want to redeem 50 million Tether, where you can just look up their fee schedule. It's not going to be free.
Yeah.
You're going to be paying a percent or so on that, maybe more. Whereas you look at something like USDC, TUSD, PAX, HUSD, the creation redemption liquidity is often quite large. You can do $50 million with no fees. But if you want to buy Bitcoins with it, you're going to be driving that market way up. And so I think, you sort of see this trade-off where Tether has all the exchange liquidity and the other ones have the better banking liquidity.
Yeah, and I want to start off with this conversation to give people a bit of context before we dive into the other products, because what you guys are building to me really seems like a Wall Street. It's a professional investors style product and platform rather than some of the other exchanges. So when people see a Tether to USDC trading pair, people think, why on earth would someone ever trade that? But it's for all these professional purposes, isn't it?
Exactly. And, as I see it, there's sort of two things that could motivate me to want to trade this pair. You kind of pull up these Tether perpetual futures right now. They're trading at spot 9998 cents. And you're like, that's kind of lame. That's $1. Yeah. So why would I care? Well, I think there are two reasons you'd care. The first is, you wanted to be trading on Binance, on Huobi, OKX, on, most exchanges in the world. And you want to be buying and selling coins. Well, if you sell the coins, you're not selling them into dollars, you're selling them into Tether. And what that means is that you can't trade on them without being willing to hold a Tether balance.
Yeah.
And a lot of people in the world are kind of scared of Tether. They're maybe not that scared of holding it for a minute, but holding it for a day, a month, a year, a lot of people feel like, boy, I don't know how much, I don't know if I feel comfortable with that. Even if I trust it, I don't know if my boss trusts it. I don't know if my risk department trusts it.
Yeah.
I think the worry of these people is not so much that over the course of a year it might go from $1 to 99.98 cents. I think the worry is, well, what if it goes to 70 cents and I just lost 30% of my money? And so by far, kind of the biggest use of these features is you can hedge. Is if you need to be holding 30,000 Tether on Binance, you can go short sell 30,000 Tether futures on FTX, and then if Tether goes down to 70 cents, sure, you lost whatever, you lost $10,000 on Binance, but you made it all back on your short sell on the futures. And so that's sort of the clearest use of it, is to allow you to hold and trade Tether without needing to be exposed to Tether. And there's one other thing I want to mention, which is that sometimes Tether's price does move quite a bit. right now it's trading around 1, but as recently as a few days ago, it was trading 30 basis points under a dollar. And a lot of people would have had opinions on that. A lot of people felt like, it's just gonna go back to a dollar. I should just buy here, or I think it actually might be about to crash. And this lets you bet on that with 100x leverage. You can get super long tether when it goes down a little bit, so you can go back to 1, or if you think it's going to go way down, you can get super short it. And so I think that's sort of the other clear use is if you have strong opinions about the tether premium.
Yeah. So I want to talk some about some of the other index products that you've got and the futures. So BitMEX grew to fame because they had Bitcoin and they added Ether, but a lot of those other coins were traded against Bitcoin. And personally, I've never liked trading against Bitcoin. I really want to trade against US dollars, and I think that's where you get the best volatility. So why did you guys decide to go with US dollar pairs? What were the challenges for exchanges not to do that?
So, the reason we decided to go with them is it seemed like kind of the cleanest thing to do in terms of letting people trade on the real underlying products. The real underlying product here is you're trading a Bitcoin, you're trading an Ether, you're trading an XRP token, and you can look at an Ether Bitcoin pair, and it's sort of an interesting product, but it's a cross between two different products, and it's sort of not the thing that you use to really price an Ether or price a Bitcoin. So that was one reason. The other is that that's how traditional finance does things. Everything just trades against dollars. If you want to trade two different things, you just buy one and sell the other.
Yeah.
And it sort of gives you the maximum flexibility about what positions you want to put on. I will note that we're also looking to launch Bitcoin paired altcoins sometime soon.
Yeah.
We're still going through the details of how we want to do that, but we think that the US dollar pairings are sort of really the core pairings of them, and different exchanges have made sort of different decisions about how to do this. But a lot of them face some big problems, which are that they don't have any US dollar type settlement. So if you want to have a BSV future and you can't do any US dollar settlement, what you do, what a lot of exchanges have decided is, well, I guess we're going to have to do a BSV Bitcoin future and do Bitcoin settlement. So we certainly don't want to do BSV settlement.
Yeah.
And other exchanges have decided, no, we're going to do BSV settlement, which is atrocious. I mean, it takes a day to move it around the blockchain. So, you want to hedge your position to BSV. Step 1, buy BSV. Step 2, wait for a day to hit the futures exchange, then move it into your account. Now you can start hedging.
Yeah.
And so, that's sort of quite an annoying process. And then once you've done that, you get this weird inverted futures product where you're like, all right, how much money do I make? Well, I bought these BSV futures for, $50. I sold them for $60. Did I make $10 for a BSV? No, I didn't, because that's not the trade I did. The order book's a lie.
Yeah. I was going to say, some people might get paid out in BSV as a profit for a big short position. Then they get BSV, and then they've got to sell BSV to make a profit. Yeah,
exactly. And the actual order book you're trading on is 1 divided by the order book that's displayed. Then you get paid out in the token. You're like, God, I wanted short BSV. Now I just have a whole lot of BSV. Now I got to sell on my BSV, which again, sometimes that's what you want to do, but I think it's not usually what you want to do. Like, usually I think you're just trying to make a bet on BSV's price or hedge, and you didn't want to have to deal with spot BSV for that.
Yeah.
And one other kind of weird thing that happens is if BSV goes to 0, then I guess you get infinity BSV. And that's what happens. Is it's supposed to pay out infinity tokens for a blockchain with a finite number of tokens, each worth 0, and that's how you get paid your $100,000 profit. And you might ask, well, tokens don't go to 0, but sometimes they do. And as an example, forks, right? And this is a thing that caused a huge shit show for some futures exchanges a year ago. Was BCH fork to ABCs and BSVs, and everyone thought maybe one of them is going to 0, and we don't even know which one. And if that happens, then these futures might go to 0, and then they'd have to pay out infinity tokens. So there's just a ton of pretty ugly things that happen. And all of this stems back to not a really intentional decision by the exchanges. It's the fact they don't have dollars. So they can't do a Bitcoin USD future because they don't have USD. So they have to do these weird inverted futures or Bitcoin settled. But stablecoins are sort of the obvious solution to this, is that you do a stablecoin settled future. And then you can have your USD exposure, you can have your USD settlement, you can have standard non-inverted futures, but you don't need a bank account. You don't need any bank to trust crypto. You don't need users to have bank accounts. You can just send it in and out on the blockchain. Or if you want to be really fiat USD, then you can just create and redeem all the stable coins you send in and out.
Yeah. The next thing I wanted to talk about was the baskets that you've got. I guess they're similar to an ETF. People can think of these as. So you came out with the altcoin index, and that allows people to take a bet on some of the large cap coins. And then you had the mid cap, and now you've got the shitcoin index as well. So it's an ability for people to literally short shitcoins if you think they're going down. So fantastic products. Maybe what's happening on the back end for people that don't quite understand these.
Yeah. So, they're structured the way traditional index futures work. And so basically what that means is that, I think it's maybe easiest to think about the quarterly expiring futures, whereas a Bitcoin quarterly future expires to the price of a Bitcoin in, a month from now. The mid cap index future is going to basically look at the price of all the tokens in its index a month from now and average them together. Yeah. And that's going to be the price of the future. And so what it does is it basically lets you bet on the average performance of a whole basket of coins. And yeah, kind of the cool thing about these is that, sometimes you just really think Leo is going to go up, and then, you should trade Leo. You should buy Leo futures, buy Leo. But sometimes you just feel like large cap altcoins are going to go up, and you don't really know which one. And yeah, sure, you could go buy a ton of EOS, but maybe bad news comes out about it. And altcoins in general went up, but now you're stuck holding EOS. And it's not so much that you're going to lose money on average, as that it's just going to add a lot of unnecessary noise to your trade. Yeah. Or maybe you think that BCH is really going to perform well relative to crypto, but you don't really know what altcoins are going to do. Yeah. So you can buy a bunch of BCH, but then just like crypto interest dies down and you lose to it, even if BCH overtakes Bitcoin. And so with the altcoin index futures, you can buy your BCH and then short sell the altcoin index future to hedge it.
Do you find that that's settled down the volatility? So someone might want to jump in and buy an oversold bounce in a big sell-off, but then there's a big week on ETH and they get liquidated, and their bet that altcoins are about to bounce is correct as well.
Oh yeah, absolutely. And what you'll see is that during most moves, most coins move about the same amount. It's not a huge difference, but then there are outliers. And if you look at the giant things where a ton of people get liquidated, often it's like some coin like XRP just went up 30% or something like that. Yeah. It's some random coin just idiosyncratically outperformed or underperformed a massive amount, and anyone who is more than 3x levered got liquidated. And, if that's not what you're trying to bet on, if you just want to generally bet on altcoins, that's not the game you're trying to play, Yeah. And so, the altcoin index feature during most moves, it'll do about the same as what Ether or Ripple or US will do, but sort of without those gigantic outlier movements in both directions.
The next thing I want to talk about was the tokens that you've built as well. So these are different to a contract where you trade against someone else. And what you've built there is tokens that enable people to hedge, but also the bull and bear that are triple, to the upside or to the downside. So if someone thinks that Binance token's going to go up, they can buy an ERC20 token that is a triple leverage token.
Yeah, that's right. So, so these are the leverage tokens. And as you said, they're ERC20 tokens that have sort of leveraged price movement. So there is, BNB bear, for instance, which is, a negative 3x BNB token. And what that means is that it's just an ERC20 token. You can buy and sell it like any other token, but it moves 3 times as much as BNB does. Yeah. It negative 3 times as much. And there's BNB bull, which moves positive 3 times as much. And kind of the cool thing about these is it's not that it's the only way to get leveraged exposure in crypto, but it is maybe the easiest. And, if you think about doing a typical margin trade, there's a lot that goes into it. I mean, you have to post collateral. You have to think about your margin. You have to think about your liquidation risk. You go to bed, you're like, oh God, am I going to be liquidated when I wake up? Yeah. And maybe that's what you want if you're a 24/7 quant shop. But maybe that's not what you want. Maybe you just want to get really long some token and not have to think about it for the next couple of days.
Would you agree that there's something that should be held long term? I've done videos about this recently about how there is a bit of decay with the volatility and whatnot.
Yeah. So I think it depends on what trade you're trying to do. And what happens long term is sort of interesting. And the places, so on a single day, they do exactly plus or minus 3x times as much as their underlying. What happens on a long term is that it's that each day it has 3x the move, but going up 30%, then going up 30% is different than going up 60%.
Yes. Because
that second 30% was on the increased price.
Yes.
And so because of that, you get different overall price movement if you say this thing went up 80% over this time period, or this thing 4 different times went up 20%.
Yeah, the easiest example I can give to people at home is if something's $100 and it drops 20% to 80, it's actually got to go back 25% to get to break even. So that's where you
Exactly.
get these fluctuations.
Exactly. And so these things are doing the daily thing where each day they move 3 times the percentage move. And so because of that, on long time scales, they won't do exactly the same thing as a 3x move from the beginning. Rather, they'll be the sum of the 3x of the daily moves.
Yeah.
And what that means, basically, there are a few ways to think about it. I think the cleanest is that it'll compared to a 3x movement, it'll do better if things have momentum and worse if things have mean reversion.
Yeah, yeah.
And so the key thing here basically is that, if things go up, 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 then the leverage tokens do well because each day they're basically reinvesting their profits. And if things go down, 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 they'll do better because rather than just getting liquidated, they'll be sort of continually deleveraging to sort of manage the risk. But on the other hand, as you said, if things go down, up, down, they'll do worse because things go down, they delever a little bit because they're worried about liquidation, then things go back up.
Yeah.
But they'd already delevered, so they make less.
Yeah.
On that up move, and so they end up down to a minus 10 plus 10 move.
Yeah.
And so, what I'd say is, in terms of holding them long term, obviously not investment advice, et cetera. But, in general, compared to putting on a 3x position, basically the advantage is, the big advantage is like you don't have to worry about liquidation. Like they'll sort of manage liquidation risk for you, and they'll reinvest profits and stuff. And then the price movement thing, what I'd say is, it depends on what you think. If you think that things are going to be momenti, that things that went up are going to keep going up, things that went down are going to keep going down, then they're great. And if you think things are going to be mean reverty, that there might be daily movements, but long term, a Bitcoin's not going to move. That if it goes up to 11,000, it's just going back down to 10,600 the next day. Then they're not good. This isn't doing what you want. So I think that's sort of the core difference over long term between the leverage tokens and just putting on a leverage trade.
Momenti and mean reverti. I think we've just coined 2 new words there. But talking about that holding on for a given period of time, a question we often get is, I want to take a longer term perspective. So when would someone use those perpetual futures versus the monthly or quarterly we see on other exchanges that have a sort of settlement date?
So I think that there are sort of 2 key differences between the perpetuals and the quarterlies. The first, and this is the reason I think perpetuals are popular, or one of the bigger reasons, is that they never expire. So if you buy a quarterly future, then in a couple of months, it's going to go away and turn into dollars. And if you just want to be long Bitcoin forever, you're going to lose that exposure and you're going to have to rebuy in every quarter. So that's, whereas perpetuals basically, in effect, they sort of rebuy you in every day automatically.
Yeah.
So that's one nice thing about perpetuals. You never have to worry about expiration, about your exposure going away. There's a second difference also between quarterlies and perpetuals, which is that quarterlies are basically 3-month long futures. So when you buy it, you're buying a Bitcoin plus 3 months worth of interest rates, or selling 3 months worth of interest rates. Yeah. And perpetuals are basically daily futures. So each time you buy one, you get a day's worth of interest rate exposure. Yeah. And then that sort of floats around. So you buy it at a price, and then sort of each day you pay that day's interest rate. Whereas with quarterlies, you just do it all up front. And, which is better? I mean, I don't know. It depends on what you're trying to do. It depends on what interest rates are, and it depends on which direction you're going. So I think that you sort of have to compare prevailing prices and rates and think about what direction you're going, how long you're holding, to figure out which is better at the moment. And whether you'd rather lock in some interest rate or just pay whatever kind of the market rates are each day. And a second thing that I want to highlight here is that this isn't a fee. It's a transfer between longs and shorts. So you use the word pay, but you might equally receive. As this is true, both of premiums and funding payments, that if futures are trading rich, you can sell them and get paid funding each day. Yeah. Or you can sell them and get paid a premium. And so this isn't like an expense that's built into it. This is something to keep it in line with the underlying, where you'll either win or lose to it depending on which direction you're going.
Can you just unpack that statement for people at home? You said when futures are trading rich. So when there's a high demand for something, a product, right, that's when you can actually get paid to lend it or to trade it, can't you?
That's right. And supply and demand is sort of the right way to think of this, is that if there's a ton of demand to be leveraged long Bitcoin, then you're going to end up paying something extra to do it because no one's going to be willing to sell it to you at the current prices. Yeah. And so you're going to be paying a premium on quarterly futures, or you're going to be paying daily funding rates on perpetuals. Conversely, if there's a ton of demand to get leveraged long something and you short sell it, you're going to be paid that. You're going to be paid what the other side is paying. And so you'll get paid funding each day, or you'll be able to sell above the price of a current Bitcoin for quarterlies.
Yeah, and just to tie this all back for our viewers at home, I know people hear about these lending platforms that offer 14% a year. That's around 1% a month. But if you think about what traders are doing and the fees they're paying each day, they're the sort of people that are borrowing these coins, aren't they?
Yeah, that's exactly right. And one interesting thing that you see is that there's a lot of synthetic interest rate products in crypto. There's these borrow lend desks, there's these DeFi lending solutions, there's futures, there's perpetual swaps, there's margin trading on exchanges, and there are all various ways of borrowing in order to get leveraged trading, and they all have various interest rates built into them.
Yeah.
And when thinking about this, I think there's two key things to think about. The first is how big are the interest rates, because there's a huge range. But the second key thing is this a fee or a transfer? I think this is a key thing, is that in general, for whatever reason, this is not true in all spaces, but it's true in crypto in general, that futures, generally it's a transfer, not a fee. So the exchange doesn't make any money on the funding payments or the premiums. You can make just as much by short selling as you can pay by going long, or vice versa, depending on which direction things are trading in. Spot margin trading, generally, I mean, there's a difference between different platforms, but generally you're kind of paying whether you're going long or short there. And so that's sort of the other key thing, is not just look at the size of it, but like, if you go in the right direction, do you get paid, or are you just paying both ways?
Fantastic. It's great to tie that all together for people at home. Now, you recently launched your own exchange token, and everyone knows how successful BNB was, and then we saw other exchanges start to replicate that IEO model, and I'm not a big fan of IEOs, but you guys have got a lot of use cases for that FTT token. It's already done pretty well since you've launched it.
Yeah. So FTT, it's the exchange token of FTX, and what does it do? It does a lot of the obvious things. So, if you hold it on FTX, you get lower fees. There's a weekly buy and burn of a third of the fees on FTX, where we just buy back, that much of the token and burn it. There's also some sort of more unique thing. So we have an OTC platform attached to it, and you get tighter OTC spreads if you hold FTT. And then we also buy and burn 10% of the insurance fund. And so, if the insurance fund is net increasing in value, which it has been, I think it's almost never been drawn on, and basically only ever increased. 10% of that we're going to be returning to FTT holders as well. And so those are sort of the core use cases right now, and that's going to be sort of growing over time. One last thing, that I should mention is you can also use it as collateral on FTX.
That's my favorite part. And full disclosure, guys, I did take part in that ICO. So.
Yep. And sort of to point to something else you said, I think that we're seeing really poor performance of, with the exception of Bitcoin and maybe a few other coins, really poor performance of sort of coins that are nothing but coins. There's sort of this fad that crypto went through, where you just create an ERC20 token, say you'll think about creating a business someday maybe, and then you try and sell that ERC20 token. And it started creating something out of nothing. And not shockingly, a lot of those are going back to nothing. And I don't know, I sort of expect that to continue, that like those coins are going to keep going down. And, medium long term, what are the coins that are going to become real central fixtures of crypto and finance in general? I think, maybe you'll see a few top coins filling roles like, gold and other products like that, which really are just sort of things that create their own value. And I think Bitcoin's a decent guess at, what that might be. And then I think you're going to see tokens that have, I think utilities are the PC word for it, so to say. But, coins that they're not just tokens, that they're actually, tied to some real thing. And, I think exchange tokens are one of the more exciting and kind of coolest use cases of that, because there's a lot of nice transparency associated with it. You start like some peanut butter business and you're like, here's the token for my business. No one has any clue if that token's getting a fair shake out of your peanut butter business, because who knows what your peanut butter business is doing. But the nice thing about exchanges is it's pretty transparent. I mean, you can
100%,
see public volume numbers, public fees collected. You can just sort of do the math. You can see the rebates you're getting, and so it's a really nice use case for a utility token. And I would expect over time people are going to think of more types of tokens like this, where there's some nice, somewhat easily auditable, or at least sort of like ballparkable, um, company or project or revenue stream or something, and some token that plays a role in it. And I expect that to sort of, people are saying, when's alt season? My guess is the next alt season, it's going to be a slightly different one. It's going to be an alt season of tokens that have, actual real utility.
It's so funny you say that. Like, I couldn't agree more. We've been saying that 99% of projects are going to fail. Recently, we had one of my favorite projects that was doing a lot of things right and producing revenue, and they still failed. So you have to be so careful when you're investing in these really risky startup projects. I guess the next thing I wanted to talk about was maybe some mistakes you've made or lessons, because a lot of people jump into this and they can get access to 100 times leverage and wish they had learned some more.
Yeah, so let me just start off by telling you the single biggest mistake we've ever made. This one's easy. So one thing that you learn if you try and do quant trading on 30 platforms in real time for 2 years is transfers are a fucking pain in the ass. And maybe you think they're fine because you've only ever sent Bitcoins between Coinbase and Bitstamp, and you're like, this works. I don't know. I keep sending them back and forth. But then you realize that there's thousands of coins and hundreds of platforms, and they all have their own rules. And it's not okay if most of your transfers work. Like, it's not like, 90% work, that's good. Like, no, that's terrible.
Yeah.
You'll lose all your money within a month if 10% of your transfers are getting destroyed.
Yeah.
So we've put a lot of work over the last few years into an automated transferring process. We have rules stored for every single coin on every exchange. We have automated systems that, scrape addresses, look at stored it serves this whole process. And where did that come from? Well, early on, we sent a lot of XRP tokens from Kraken to BitHum. And you can, I think this is still true. I don't know if it's been fixed, but you can kind of Google XRP from Kraken to BitHum, and you'll see a lot of people complaining. And the reason they're complaining is, as it turns out, for some kind of mysterious reason, their protocols just don't talk to each other. So you send your XRP tokens from your Kraken account to your BitHum account, and they do successfully hit BitHum's cold wallet, but the tag doesn't make it.
Okay.
So BitHum has no idea who sent it or who to credit it to. We sent a lot of XRP, like a lot of XRP from Kraken to BitHum, and we did eventually get it back after a month or two. This was February 2018, and if you remember what happened to XRP's price in February 2018, it was not a good time to have a lot of XRP sitting unsellable. We lost mid-single figure millions of dollars on that. And that's in some sense that's sort of like a stupid mistake. Like, obviously, we should have had some system. It's not like we sent one gigantic transfer; we sent like 1,000. And obviously, we should have had some system to alert us after the first one didn't land that, like, hey, like, you should look into this. And, since then, that's what we built, but we didn't have it at the time. And we sort of manually checked, like, are these transfers landed? We're like, yeah, like, we spot checked 10 transfers of XRP, and all 10 of them landed. The problem was 10 wasn't enough, right? We sent, like, 10,000 transfers, and 99% of them landed. And that means 100 transfers didn't land. And that's a lot. And I
was going to ask you about, have you heard of the Liquid sidechain that's now allowing exchanges to talk to each other directly? Is that something you guys are super interested in?
It's something I think has a lot of potential. I think with that, the devil's in the details. And the reason is that, there's sort of a few core use cases of it, but really the biggest, I think, is basically, it's like, look, Bitcoin's slow. It takes half an hour to move your Bitcoin around. What if we made that faster? How'd you do that? Well, it's hard to speed up the Bitcoin blockchain, but you create this little side chain. And basically, you're like, all right, let's just like create some really slimmed out blockchain that doesn't have a lot of congestion, and let you just like basically move a little wrapper on your Bitcoin around that side chain, and then exchanges will sort of like true it up each day. That's basically what's happening. And it's a really cool idea because it could cut Bitcoin transfer times down from 30 minutes to 30 nanoseconds potentially. Maybe not nanoseconds, but maybe milliseconds even. I mean, it could be fast.
Definitely something I think people are going to be interested in.
And so then you can ask, oh wow, why hasn't this taken over? Like, And well, here's one good reason. Things like this have existed for a while. There's this thing called, I think it's WBTC,
Yeah.
wrapped BTC, and it's exactly this on the Ether blockchain.
Yeah.
It's just an ERC20 token that it's basically a stablecoin on Bitcoin.
Yeah.
So it's an ERC20 token. You could create and redeem it for Bitcoin. And so you can ask, like, why didn't this solve the problem? Like, why is anyone using the Bitcoin blockchain anymore? Why isn't everyone just using WBTC? And there are two reasons. The first is if no one else uses it, I can't use it, right? I can wrap up my Bitcoin, but if Binance doesn't accept WBTC as Bitcoin,
it gets back to that liquidity tether thing we were talking about.
Exactly. It's like liquidity begets liquidity here. And like, you don't, if no one else is using it, then you can't use it. So you sort of need everyone to agree to use this. And these are a lot of competitors that you need to get to cooperate with each other. And obviously they're terrified of losing user funds. They're not just going to be like, great. Yeah, let's do it. They're going to be like, all right, let's like sit and think really hard about whether there's a way for all this money to be lost.
Yeah.
There's a whole risk section to this. And then the last thing, and this is also one of the keys, is why are some blockchains faster than others? Well, there's a lot of reasons, but one of them is there's not as much activity going on them, right? So if you actually moved every single Bitcoin transfer to a new blockchain, some blockchains are legitimately faster than Bitcoin, but you lose some of the gains that you're going to get because now it's just as congested. And so you get back to this thing of like, well, it's got to be like we're just batching big transfers here or something like that. And then you have to think about like, well, how do we know these are going to be honored? Like, is it some weird sidechain thing? It's clearly not exactly the, So it's a really cool idea and it could be really useful.
Yeah.
But there's a lot of things that have to go right for it to get mass adoption. And 1/4 adoption is not worth that much. Like, you really do need the world to go all in. And one cool case of this, I think, is Tether. Tether historically has been an Omni token, which basically means it moves on the Bitcoin blockchain. And so it took, half an hour to move your Tether around. And for a while, 10% of places accepted the ERC20 blockchain version of Tether, and it was literally never used. There's like 3 million in existence because it doesn't help you if only one of the exchanges uses it.
Yeah.
You need both to do it. And you need them to have reserves on hand, which means you need it to be the thing everyone's using. And so it's just like for years, no activity at all in ERC20 Tether. And in the course of a month, the majority of the world's volume switched over recently.
Yeah. A lot of that was media driven as well, I think.
Exactly. It's media driven. I think Binance was a big part of this. I think everyone was sort of like waiting for a cue on like, what's the real Tether? And everyone's like, it's Omni. Like, there are a lot of exchanges that only do Omni. And then Binance one day announced, we're only doing ERC20. We're getting rid of Omni.
Yeah.
And overnight, everyone's like, okay, like, 20% of the world's spot volume overnight just switched from Omni to ERC20. All of a sudden, ERC20 is now around 50%. And it's faster, so yeah, okay, it's time to switch. And you just get this giant network effect where nothing happens for a while, then all of a sudden everyone moves over.
And that is a positive network effect for Ethereum, but let's not go into that debate today. I want to talk about different order types. I know a lot of traders talk about that and how exchanges, some of the biggest exchanges in the world, still haven't added a lot. So I'm sure that's on your to-do list.
Oh, absolutely. I think this is something we took a little bit too long to add. We've started adding more of them recently, so now have stop limit, stop market, trailing stop, limit orders, and we have more order types coming soon. I think maybe the reason that we took longer to add them is it's just a blind spot on our part, and the reason is we're used to automated trading, to API-based trading, and a stop order is not useful if you have a bot 24/7 staring at markets trying to decide when to sell. You don't need to put the stop out there. You can just wait till markets hit the trigger price and then send a limit order.
Yeah.
But of course, if you're not doing that, then you need a stop order. You need various triggering functions. So in retrospect, that's stupid. We should have done that earlier.
That's all right. I was going to say, you're right. Continue. Sorry, man.
Oh no, sorry. What?
I was just going to say, you sort of rose to fame during that madness of when someone tried to dump $100 million on Binance, and I was actually at the computer at the time, and that was pretty crazy to watch. So I was going to say, what's it like, I guess, being a Bitcoin whale or exchanges? Like, do you meet a lot of these people that are not the usual suspects for what people think Bitcoin whales are?
Yeah. So if you think that I, at the end of each day, go to my private, Bitcoin whales chat. No, there's nothing. we develop nicknames for them sometimes internally. We'll be like, "There's Bob again," and the reason is that we only see them on exchanges, and we don't actually see them. We just see their orders.
Yeah.
And so, who is it that sold those Bitcoins? I don't know, Binance Bitcoin seller guy.
Yeah.
And I think part of this, I'm actually not the most connected person in the crypto trading world. I've been trying to grow that out pretty massively recently because now all of a sudden I'm of a consumer facing business, and it's really important that I know who traders are because I want to talk to them about FTX. But for a while I was just sitting behind my computer. It just didn't matter who it was. It just mattered that someone was doing something, and rather than knowing the person behind it, we just sort of look for people's signatures and be like, oh boy, that guy's at it again. The guy who does that thing.
Yeah, and a lot of exchanges do have fake volume and bots. I did a video about this the other day, but you said you weren't that well connected, but you are, I guess, comparatively to a lot of other people. That's why you had liquidity to start off with.
Yeah. So Alameda obviously is a big piece of that. Is that because we're incubated by a liquidity provider, before the exchange had its first trade, it had the most liquid order books in the world, and that's a huge advantage because, again, this is a network effect, right? Why aren't there liquidity providers on new exchanges? There's no volume. Why isn't there any volume? Well, the liquidity shit, and it's really hard to break out of that cycle. Yeah. And you sort of, it's a chicken and egg problem. And we started with, I don't know if it's the chicken or the egg, but one of them. And that's allowed us to jumpstart volume a lot more quickly than otherwise.
Any other products on the horizon? We sort of spoke about maybe a volatility product. People love trading the VIX in the stock market world, or sort of what is that long-term vision for the platform now?
Yeah, so I think the next big project is going to be volatility products. That's something we're hoping to have the first products out the next month or two. Obviously, a lot of small things, more order types, more futures, UI changes, things like that. But on the bigger side, I think volatility products, totally redesigned mobile interfaces is maybe our other big project going on right now. That's, again, something we're hoping in the next month or two we'll have out, Android and iPhone apps. Yeah. We do have an Android app right now. It's not very different than just the website on your Android, but there's an app button for it. Yeah. But we're hoping to have totally redesigned interfaces for those soon. And then after that, there's sort of a whole stable of things that we're looking into, and we're actually not sure which we're going to do next. But to just kind of give you the list of things we're looking into, I expect after options, the next direction is going to be one of sort of new types of crypto derivative products. So hash rate futures, Bitcoin dominance futures, things like that. It might be prediction market stuff. So, crypto and stablecoins in particular are a really obvious way to settle online prediction markets. And, there are also futures contracts that need a matching engine. So it sort of fits very nicely into the infrastructure. It's obviously a different type of product. And, part of what we want to know is is this what people have demand for? And also, does this overlap with our current customer base, or would we have to find a totally new one? But we'd love to have a Trump 2020 contract. Will Trump win the 2020 presidential election? Binary future.
Taking some market share off Augur, the guys over at Augur, maybe.
Yeah. So that's sort of another big project that we're looking into. There's a few others which are maybe even earlier on. Maybe listing futures on stocks or stock indexes, futures on commodities. These are things where both, we want to see what the demand is like for them. Also, there's some regulatory due diligence to do on those because they're under a different framework. And, obviously we're trying to be responsive to 50 different countries, governments all at once. And that's a complicated process. But those are sort of the things that are in the, in the running for what we're going to do after volatility products.
Well, hopefully you guys at home can see why I'm bullish on the FTT token and why I've moved over to this exchange, because I really think it is going to take on Binance and be top 3, if not number 1 in the world. So thanks so much for coming on, Sam. Any final thoughts for people at home?
Of course. Thanks for having me. And I think the last thing I'd say is just, obviously be really excited for you guys to check out FTX, just ftx.com. And really excited to hear your feedback. We want this to be the platform that works for you. We've made a lot of changes based on what people have said, things that maybe we should have known but didn't. And we really want to hear those. We really want to hear like, boy, this would be great if you had, IOC orders. That's the thing that I really need. Or like, hey, like your login interface is really shit on Microsoft smartphones. It just like doesn't work. Or whatever it is. Worst case scenario, we'll say sorry, that's actually really hard. But for a lot of these, it's not that hard. And half the battle is just knowing what people want.
Awesome. Well, guys, that link does get you some discount on fees. So thanks to Sam and the guys. And I'm sure we'll talk again soon.
Awesome. Well, thanks for having me.
Cheers, guys.